Today on InvestTalk, we look at an underrated industry impacted by the great wealth transfer in front of us. Then we look at why the market faded all day after being up after hours. We also answer questions about AMAT, Lumen technologies, and more. And then at the end, I look at the US economy and if it's really headed into a recession.
This is InvestTalk. Independent thinking, shared success.
888-999-CHART, 888-992-4278 is how you get through and ask your question on today's show. Now, my main focus point is about the great wealth transfer, and it's unfolding in some surprising ways. And according to a study by Edward Jones, by the way, Edward Jones, not a place you ever want to keep your money, but they did a study and they surveyed Americans, and nearly a third are expecting to receive an inheritance. And among those anticipating one, nearly half expected to come within the next 10 years. And this is what many are calling the great wealth transfer. Handing off trillions of dollars, trillions of wealth, shall we say, from the older silent generation and aging baby boomers to Gen X, millennials, and Gen Z adult children and grandchildren over the next 10 to 20 years. Now, mostly it's coming from boomers. It's going to be about $84 trillion worth. $72 trillion will go to heirs. $12 trillion will go to charities. Now, this includes cash, equities, real estate, and other forms of wealth. Okay. Now, the first thing you must do, and I have firsthand experience with this, is, and it can go in both directions, but it typically goes in a poor direction unless there's clear communication from the person who is giving the wealth to the next generation, is there needs to be transparent conversations between family members, developing that clear plan, communicating that clear plan in writing and verbally, okay? And it will create a big difference between love and care during the transition period and potentially hurt, confusion, and a lot of strife for all around, especially in a time of grieving. Okay, so that's first off. Make sure your family is communicating. Now, many people or many of these elder statesmen of the family, they're handing off wealth in wills and trusts, but they're also choosing a lot of giving while living, is what they call it. And these are doing things like paying for college funds, paying for weddings, and helping their children and grandchildren pay for down payment on a home, for example. And the number one, those other ones you've kind of heard of. But what's becoming even more common is the gift of travel, okay? And this is multi-generational travel. And this is actually something Steve did. Luckily, he was still able to do it. He was pretty sick when he went, but he still was able to do it with pretty much his entire family. They went to Europe for a couple of weeks. And so he was one of many that are doing this, is paying for these shared experiences, making memories with their children and grandchildren. And so these boomers are bringing big and small family groups on a lot more of these experiences. According to U.S. Family Travel Association survey, 50% have taken a multi-generational trip in the last 3 years. And more than half, usually grandparents, report being the primary planner and organizer of these trips. Now, 50% indicate they pay for the trip completely, and 48% say they share the cost with the family. Okay, so it is split roughly 50-50. And people are viewing these as ways to give back, give to the next generation, but create shared experiences. And I think this is amazing. I think this is awesome. This is much better than just giving the money to the next of kin. It's a great way for those that have the means to really create that connection that will last many lifetimes, hopefully, right? Those experiences will pass on from generation to generation. Now, in 2019, a survey, 61% of grandparents reported being interested in vacationing with grandchildren alone and skipping the middle generation. So a lot of times it's not just, hey, I'm going to take my kids. It's I want to connect with my grandkids. And that's happening more often as well. And so the standard imagery of cutting large checks, giving homes away, transferring portfolios, it's incomplete. It's become more than that. And I think it will have a very interesting impact longer term on the travel industry, because it's not just the older generation that are doing it. Younger generations are doing it. Millennials, Gen Z, they're often opting for less things and more experiences. So I do think there's some structural tailwinds in the travel industry, and it's definitely a place we continue to look for investment opportunities. Now, doesn't mean you buy airlines, but it could mean, online travel agencies, things like that. Those are probably the best places to allocate money longer term. Now let's take a quick look at the market today. It started off the day fairly rosy. You had some comments from the Bank of Japan after the U.S. market closed. And what they said was, hey, if the market gets volatile, we'll stop. We'll stop being hawkish. We'll stop raising rates. Maybe we'll even stop QT. And the markets overnight like that. But throughout the day, it faded. And the S&P closed down 40 points, a little less than 1%, about 0.8% on the day. Small caps are down a little more than 1%. And as you would expect, as this yen carry trade unwind continues, most of the selling is happening in large cap tech. That was down 1.4%. Even small cap growth was down 1.5%. So some big losers there. Let's see, what were the big? Lyft was down 17% on the day. TripAdvisor down 16%. What else? So very interesting. Tesla was down 4%. And as I said earlier, this is not going to end in a short period of time. This is going to probably drag out in a very choppy way. And you saw that with a little bounce off support a couple days ago. And now it looks like we may be headed to that next level of support. The next major level, if we break Monday's lows, would be around 4,900 on the S&P, 4,900. That means we would go from 5,670 all the way to 4,900, which would easily clear that 10% level pullback and get us closer to that 15% drop in the S&P 500. The NASDAQ would probably be close to a bear market. And I do think we probably get there sometime later this quarter or early next quarter. So that's what's happening. It's still a choppy environment for the near term. But once again, as I've said, probably not any catalyst for a major credit event or bear market.
Hey, Justin and Luke, I'm calling you today to look at the stock Innospec, IOSP. It's a small cap chemical company with net debt on the balance sheet. And I own it right now, but I was wondering, is this worth keeping? And if so, what would be a good level to add more? Thank you.
All right, looking at Innospec. Innospec is the symbol. And they had earnings that the market did not like at all. Revenues were down 9% year over year. Earnings were still positive 9%, but obviously the market was expecting better than that. And this is another good example of, it's not about what that headline number says. It's not about what happened in the past. It's about what happened to market expectations, or what happened compared to market expectations, excuse me. So this peaked out around 130 just a few days ago. Now it's down to 106. The technicals certainly are, I don't want to say broken, but they're not looking good. Now I'd have to look at what they said about forward guidance and things like that. But I tend to follow this type of decline with a bit of a worry. Now it could snap back and close the week above, say, the 100-week moving average, which would be around 110. If it can do that in the next couple of days, I think it looks a lot better. But as of now, this is a technical break that you have to pay attention to. So I would hold it for now, but it's definitely on the chopping block. The good thing is they don't have any debt. like you said, very clean balance sheet. And clearly the market isn't liking what they're expecting for the coming quarters. So it's on the chopping block for sure because of this market reaction and the change of tenor of that chart. So I would be looking to cut it, like I said, but if it doesn't close above 110 by the end of the week, I would be selling it. Thanks for the call. Now, from time to time, we receive InvestTalk questions from the comment section over on the InvestTalk YouTube channel. So make sure to head over there and you can submit your questions. Ulam Spiral says, thanks for a great show. Do you have any thoughts on Australian data center company NextDC listed on ASX under NXT? Interesting one here. And, we don't get a ton of data on, you can see I don't look at these beforehand. Let's see, they operate 13 data centers across 5 major Australian cities to focus on coalition and interconnection between enterprises. Let's take a look. I typically like, the data center business. And Australia, I'm not getting a lot of data here. Let me pull up a chart. Not very liquid, that's for sure. I wish I had more for you, to be honest with you. The market cap's $4 billion. The general trend is positive. So, the technicals are good, but I just don't have enough. I wish I could tell you. I just don't have enough data, at least with the systems that I have pulled up right now. So let's pivot over to another voicemail question now.
Hi, guys. Big fan of the show. I just had a question about ticker IMNN. It's been trading pretty low for a while now, but it's got a price target of $10.75, and it's been trading around the $1 mark for the last couple of months. So I just wanted to get your guys' thoughts on, how trustworthy are price targets, analysis targets, being compared to how a stock is actually trading. Thanks, guys. Big fan of the show.
Well, price targets, you take them with a big grain of salt, frankly. It's interesting, but, those price targets are based on just guesstimates. They're educated guesses. And it's unless there's some insider knowledge, which these analysts don't have, these price targets don't mean anything. They might be based on algorithm or whatever, but this IMNN, it's a $10 million market cap. This is a micro cap, loses money. You might be looking at it went from about $1 per share a few days ago or sometime last week. What was that, on the 30th? It spiked all the way up to $3.60 per share in one day. And then the next day it fell all the way back to $1.30. Now it's back to the close of the day, $1.07. It loses money like most biotech companies. That's what it is. It's the biotech name to treat cancer. This story is as old as time. And as you know, they haven't cured cancer. So this is just a story stock. You probably heard about it somewhere. It's just trying to steal your money. That's what these biotech companies do. They spin a great story. I call them the original Ponzi stocks. And you want to avoid this type of name like the plague. Okay.
Hey, Justin and Luke. This is Nick from New York, a longtime listener. I just kind of had a question today about 401/457s. I listened to your podcast yesterday, and I'm actually doing pretty good for my age range as far as what I have invested in my retirement. So what I was curious about is I happen to find, or I have most of my money in a target-dated fund through my employer. And, the options and the profiles that you can select from just are not very diverse. So I was just curious, is there really anything that you can do as far as, I'm 34 years old. Would it be smart to, say, take my money out and put it somewhere else? But it sounds like that there's no real good way to do that without taking, a major tax beating. So am I kind of just stuck in my account for a long period of time? I have 21 years left until I retire. Thank you for your help. I appreciate the advice. We'll be listening on the show. Thanks.
This is a great question. It actually ties into one of the topics I wanted to get to, which maybe I'll get to in a second. But, yeah, if your investment options are not great in your 401k and your 457 and your TSP is historically very limited, it's not a bad idea to just get the employer match. So no matter how bad the investment options are, if you're getting a 50 to 100% return on your money by getting that employer match, you have to take it. You have to get that, okay? But then beyond that, then the question is, do I instead put the money into an IRA or a Roth IRA? That's that's what you go to next if you're not happy with the investment options within your retirement plan. So that's the way to think about it. I get what you're saying, and a lot of people are feeling that way. And let me get to that. And it's interesting that he called about that, because a lot of investors are opting out of these target dated funds mainly because fees, on average, target dated funds cost 68 basis points, so 0.68% per year. Now, doesn't sound like a lot, but remember, you're not getting much here, okay? You're getting a blind allocation that changes only based on your age. That's it, okay? So it's on this glide path. And that glide path might be good, it might be bad based on where the valuations in that particular asset class are, right? So, for example, 3 years ago, when interest rates are very low, bonds were very rich. If you were in a target dated fund, say a 2025 target dated fund, you were in a lot of bonds. And those bonds went down a lot because interest rates rose. So it didn't care whether we were heading into an inflationary environment or a Fed tightening cycle. Did not care at all. It's going to be in bonds. And the corollary, if you are in a targeted fund that goes out to 2060, 2070, potentially, right? You're really young, you're going to be almost all equities. And it doesn't care whether equities are cheap or expensive. And it's typically just investing in an index fund. That's it. And what's crazy about this is that this is the default choice for millions of retirement savers. And so a lot of people are opting out. Maybe they want to be a bit more aggressive. They want to find funds that are maybe value focused as opposed to just indexing, which the vast majority of these targeted funds are just doing. And so it's a really interesting trend. And I think in some ways it's good, some ways not so good, right? A lot of people might be taking too much risk for their portfolio. And this is something we do for clients. We manage 401k accounts. So not only are we opting them out of these targeted funds, but we are, building a plan for them. We are looking at their risk tolerance level, because that's more important as well. It's not just looking at your age and saying, you are this age, here's your target date, this is how aggressive you should be. Everyone's different. I know 35-year-olds that are pretty conservative, just like I know 65-year-olds that are very aggressive. But the target dated fund is just going to give you a blanket allocation that may not be right for you. And so this is a really interesting question, a really, really great question, because I've been trying to get to this topic for a few shows now, just hadn't had time. So I might as well get to it because we had this caller ask about it. And you're paying these high fees and it's blind allocation. You're not getting any one-on-one advice at all. In fact, you're getting the opposite of that. You're getting some generic allocation. And so opting out of that, not a bad idea. Thanks for the call. Now let's talk a little bit about the insurance industry fighting consumer protection. This is huge. And I wanted to highlight this because I guarantee you in your life, especially if these rules continue to be shot down in court, you're going to get pitched annuities of some kind. And the insurance industry makes billions of dollars each year off of retirement savers, putting them in these high expense annuities with a lot of hidden fees. Remember, these are complex investment vehicles. If you go and sign up for an annuity, you'll know that the documentation is very long. There's a lot of legalese in there. You're going to have to hire a lawyer and pay them thousands of dollars. That's how long it's going to take them to read it all for them to decipher exactly what this all means. So they know that you aren't going to do that. You're just going to sign on the dotted line and you are going to buy into the marketing ploy of the insurance company. Now, there's been rules from the Department of Labor trying to be implemented to cover all types of advisors to make sure everybody giving investment advice is under what is called the fiduciary standard. I'm a registered investment advisor. That's our firm, KPP Financial. That's what we operate as. We don't collect commissions, and therefore we don't have that conflict of interest. And that's what the Department of Labor is trying to get rid of, is the conflict of interest that you typically get from most brokers, especially those that are working at an insurance company or with an insurance company. A lot of times it's a broker at, an Edward Jones, for example, and selling a commissioned product like an annuity. And this rule would curb commissions on annuities sharply. And what's crazy is that these annuities have surged in recent years because of market volatility. And the insurance industry is fighting back to try to keep it. Now, Joseph Pfeiffer, he's the president of the Public Investors Advocate Bar Association. Okay, Public Investors Advocate Bar Association. This is his quote. Quote, insurers and agents are fighting for their right to keep ripping off clients with biased advice and sky-high commissions, end quote. Now, the insurance companies are going to say, well, you're depriving consumers from needed retirement advice. And that's complete BS because there's plenty of other options out there that are much better. And annuity sales continue to boom. For the first 6 months of this year, sales at $215 billion, beating $181 billion in the same time last year. And this is happening because these quote-unquote advisors, a lot of people call themselves financial advisors, they're not. They're salespeople. And the most common one that is sold, fixed indexed annuities, which tie their performance to the market index. And that's the quote, right? Saying it's going to track the S&P or some index, but it's going to protect you on the downside. It's going to put a floor on the losses. But what they don't tell you or don't tell you much about is the capped returns that you get when things go well. And that's the big issue, is that the complexity of this makes those fees hard to understand. And the commissions are typically between 8% and upwards of 15% on really bad products. So there's high incentive for these people to get their customers into these products. And they bake the fees into the complexity of the product. For example, one annuity carries a 0.5% annual deduction rate. So if the S&P returns 9.5%, you only get 9%. Okay. But then there's also other potential deductions like servicing and rebalancing costs. There are strategy spreads such as 1.95% a year deducted from total returns for one that was tied to the S&P 500. And there's others that cap gains to 55% of the total index's rise. So they don't tell you that they talk about the protection, they focus on the protection, and they say, it's tracking the S&P. Yes, it might be tracking the S&P, but are there any other deductions from that and fees that are going to diminish that total return? And then you're not even talking about the lockup period, which can average between 10 and 15 years. So the lack of liquidity is there as well. And so all the Department of Labor rule is trying to do is to have advisors get reasonable compensation. Isn't it reasonable for an advisor to get 8 to 15% commission on something they sold you and never have to do anything again for you? No. According to Morningstar, retirement investors would save around $3.25 billion every single year in reduced commissions on rollovers, for example, that typically go into fixed annuities or fixed index annuities. And last month, Texas judge oversaw 2 industry group lawsuits agreed to stay implementation of the new protection, meaning push it off a little farther, which is supposed to take effect next month. So I wanted to highlight that because they've been fighting this for years, and so far they're winning, unfortunately. Okay. So don't get looped into those fixed indexed annuities. Now, I hope you've been telling your friends about the InvestTalk podcast being available in video form over on our YouTube channel. And we get questions submitted via the comment section over there. So let's get to one now. Arakdon, 1964, says, interesting on your Lumen comments. Do you ever get into qualitative side of a position? I've been buying it in the 150s and lower range for a while, solely because I saw the possible synergies and other strengths that the CEO, Katie Johnson, brought to the company. The latest news is she is collaborating with Microsoft and is entering an agreement with Corning. It's possible this company could take off, or is more likely it would be bought out. Thanks for the advice. Yeah, this is an interesting one. This is a tough one. Yeah, I love this question because, yeah, there's a qualitative side to this. You know, Lumen had been on his luck. It had a new CEO, and Katie Johnson, the new CEO, didn't really do much the first couple of years. You know, tried to turn the business around, and only recently has her efforts borne fruit into future cash flows, and that's what's happening here. Now, a lot of this I do think is short covering because, you know, you had a situation where there was potential bankruptcy in the near term, but it looks like that has been saved. But how much of this is real and how much of this will be actual business that comes in to repair their balance sheet, actually return the company to profitability, to enough cash flow to support the debt level, etc. And that's a much harder thing to know now because, you know, it's a new contract. And what's the cost to fulfill that contract, etc. So, yeah, I mean, you want to ride the wave. I had a caller a couple of days ago. I said I would be looking to sell it at some point, but in the near term, it's probably going to move higher because the momentum just started. Now, I didn't think it was going to go from, I think at that time, it was trading on $3 per share. I didn't think it was going to double in the span of 4 days. Now it's at 6 and change. I didn't think it was going to go that fast. But, you know, you probably want to maybe rebalance a little bit after this move. Probably not sell it all, but it's definitely overbought. And ride the wave because it certainly could move higher if this is a big enough contract. Now let's get back to the InvestTalk voice bank for a question that came in earlier on 888-99-CHART.
Hi, Justin. I'm calling today about the freight and logistics and shipping sector. I currently own a small position in UPS. Now I was looking to round out my position in other companies such as Landstar, LSTR, or Matson, MATX. I was just hoping to get your take on what you would do. Landstar is more of a freight and logistics. I think it's in Canada, US, and Mexico, so it seems to be like good areas to be in. Whereas Matson is maybe a little bit more diversified internationally, and they're more marine shipping. So just want to get your take on these companies, and if you would round out the UPS position, how you feel about the sector, and if you would add to either finish the position in Landstar or Matson get some marine exposure. Thank you very much. Have a good day.
All right. Looking at Matson and LSTR, both in the shipping and logistics business. But like he said, Matson is focused more on ocean transportation, whereas Landstar is more, as you would imagine, land truckload transportation and logistics in the U.S., Canada, and Mexico. Landstar's business has been struggling. You know, earnings were $11.76 in 2022 at the peak of everyone buying things and products moving. But earnings are this year supposed to be down to $5.87, pretty much cut in half, back to kind of pre-COVID levels of earnings. 2019, they made $5.72. So very flattish type of business there. Whereas MATX, Matson, that one, it looks like, let me just pull that up. it's growing still. Its earnings are growing. Last quarter revenues are up 10%. Earnings are up 46%. Earnings are up 35% this year expected from last year, although still down from its peak of $27 in 2022. So I like the near-term trends. The technicals on Matson are better, and I like that. I like that ocean shipping a bit more, and it has a very good balance sheet. So I'm going to give Matson a thumbs up over Landstar, but both are solid choices. Let's go talk to James in San Francisco, looking at Applied Materials AMAT.
Yes, sir. Thank you very much. I was interested to initiate a position. I figured with the market pulling back a little bit, was just a little bit nervous and wasn't sure really what was going on with the marketplace and if I should just kind of sit on the fence a little bit and keep watching, or if now would be a good time to jump on in.
Well, I think for maybe a near-term trade, you're getting to a point where there's pretty solid support. It is a little bit lower, closer to, let's see, 160, 165. Now we're at 178. So from a technical perspective, that is good support. Now, the issue is business is slowing. Earnings estimates for this year and next year just continue to come down. But it is a good business. For everyone out there, this is Applied Materials. This is in the chip equipment business. So when the industry is expanding, think AI chips, for example, that they're going to AMAT for expansion of capacity. And long term, I think AMAT is a solid name. But near term, I see a lot of headwinds. I think there's a lot of reorganization of the supply chains, and I think there's been a lot of expansion of capacity during COVID, right, where there was the chip shortage, et cetera. And so I think their business is slowing in the near term. So I would be patient on it. Let me give you a level that I would start to think about this.
Okay,
yeah, 165 it is the start. I would say 140 is the area that would be the most interesting to me, around 140, and it's at 178 now. Thanks for the call.
Oh, thank you, sir.
No problem. Thanks for the call. Now, lastly, let's talk a bit about whether the U.S. is headed into recession. And, for the better part of 2 years, everyone's talking about, hey, we're heading to a recession, and it hasn't come. But finally, you are getting some concerns about a weaker jobs market and the overall health of the economy. And but if you look at underneath the surface, beyond the unemployment rate, there's not a lot of real world indicators that we are in a tough economic environment. But underneath the surface, you are seeing some signs of weakness. For example, think of the reports from McDonald's, Diageo, as well as Starbucks recently. And what you're seeing there is those are not your high-end consumers, right? Diageo sells kind of low-end alcohol typically. And obviously McDonald's, typically a lower-end consumer. Starbucks, that's a mix, but they are seeing weakness in the lower-income consumers, okay? And that's where the pockets of weakness are, particularly low and middle-income households. And you're seeing this in delinquency rates on car and credit cards. So, but automobile loans still are defaults are still not above pre-COVID levels, which was about 5%, and now we're at about 4% that are 90 plus days delinquent. But credit cards, they're higher than pre-COVID and during COVID, which peaked out around 10%. Then checks started going out. Those delinquency rates dropped. And now we're back to close to 12% of credit card holders that are delinquent 90 days or more. Now, that's well shy of the about 14% that we saw at the peak of COVID, but it is certainly rising. And the jobs number, 114,000, it's about the amount of labor supply that continues to come on. So if you think about it, yes, the number continues to kind of edge lower over the past year, but it stayed higher than that about 114,000 of new labor supply that comes in each month. And that's why the unemployment rate remained contained. But now that's not the case. And I think what I'm trying to say here is, are we heading to a recession near term? Probably not. But I do think 12 months from now, 18 months from now, it's definitely possible. Now, a big question will be how aggressive the Fed is in its rate cutting cycle between now and year end, and what impact that will have to kind of juice the credit cycle back higher and create a soft landing. So still TBD on this recession call. Well, that about does it. I'm Justin Klein. It's another InvestTalk program. We thank you for listening, and we encourage you to tell your friends and family about our free podcast downloads, which you can find anytime at iTunes, Spotify, or Google Play. And be sure to rate and review on iTunes as well. And check us out in video form over on our YouTube channel. Independent thinking, shared success. This is InvestTalk. Good night.